Okay, let's have a look at how the change in interest rates reflects into changes in the major asset classes, forex, equities, financial income, and commodities. Let's focus for now on forex and equities, as I think the connection is easier to see why interest rates have an impact on currencies and equities. So let's look at forex. Maybe to start off, currencies are always traded in pairs. Let's say in this case, we're trading the pair US dollar against the euro, and you can either go long this pair or short this pair. And you're always going long or short the first pair, currency in the pair. So if you go long the USD euro, you're basically going long USD and short euro. So you're basically betting that the US dollar will appreciate against the euro. The US dollar will be stronger than the euro. And if you go short the USD, you go long the euro. So you're basically saying the USD will lose value against the euro. Okay, so let's have a look what happens. Let's imagine we have Mr. Tom, and he has 100 euro, and he has the following investment options. So you can either invest in the Fed, in American banks, which are regulated by the Fed interest rates, let's say, and they currently have an interest rate of 3%, and the European Central Bank is currently giving out a interest rate of 1%. So Mr. Tom has two options. He can either transfer his money to US dollars and invest in the Fed, or can keep his money in euros and put it in the European Central Bank. Now let's assume that Mr. Tom is a rational investor. So what will he do? He will take the one with the higher return, assuming that they both have the same risk. Let's assume that. So he has these two options, and of course he will choose the bigger one. So he will choose the US dollar, because he will get 3% if he puts 100 US dollars into the American banks. So let's make a second assumption. 1 euro equals to 1 US dollar. Now he wants to do that. He wants to invest in the American banks. He wants to put his money into the American banks and get his 3% per annum. So the first thing he has to do is to transform these 100 euro into USDs. So what does he have to do? He has to buy with 100 euro, 100 US dollars. In this case, we've simplified it as the exchange rate is the same. So what he does is basically buy 100 US dollars. What happens though? If you want to buy something, that means you have a demand. So let's say demand goes up because the Fed has a higher interest rate for ECB, so the demand rate goes up. And this, if you remember in microeconomics, implies that if demand goes up for something, price goes up. So now we have a clear relationship, and in this case we say, okay, the demand for US dollars goes up, so the price of US dollars goes up. Basically what's happening is, in general, the US dollar is getting stronger as more people want to transfer or exchange their currency to US dollars and get this higher return. Now imagine that the ECB raises interest rates, and now we've had a change, right? So now Mr. Tom sees, I can see that I can get 5% from euros, still assuming the same risk, of course. So the sign changes here. And what does Mr. Tom do? He says, okay, now I take my, let's say there's still 100 USDs, and now I have to exchange them for 100 euros. Let's still assume this exchange rate. So now increase demand for euros translates in an increase of price of euros. So that's why we see that if interest rates go up, translate in the underlying currency, not underlying actually, in the currency of this interest rate will go up as well. So that's the relationship with Forex and in currencies. Now, it's important to say that Mr. Tom represents a very large group of rational investors. So we could say even the population, because one guy alone won't move the market. But if a lot of people think this way, a lot of people want to buy the US dollar because of a certain interest rate change, then the market will, of course, change as there's a higher demand for the US dollar. Having said that, this is a very oversimplification of what's actually going on, and very often interest rates are already priced in, or there's a series of other different reasons why there won't be such a big change in currencies if the interest rate changes. Okay, let's have a look at equities. For equities, there's two reasons. One is more microeconomics based on substitutes. And the second one is more based on the macro view. So let's quickly go through them. On the micro view, let's say we have two options to invest. The first one is, let's say we have again Tom. This time he has $100, and he can invest in two assets. The first one is the equities market, 10%, and the second one is the American bank. So let's say interest rates, very simply put, basically. And let's say this is 2%. Okay, let's say this has a risk of 1%. In this case, the risk is not the same. Oh, I shouldn't write it like this, but let's just, I'm just going to write it like this. R is equal to 1%, and in this case, risk is equal to 5%. Or let's do just a bit higher than 5%. Let's do it, 6%. So in this case, as you can see, the risk to reward here is 2. And in the other case, it's going to be a bit lower than 2. It's going to be 1.67. So again, Mr. Tom is rational. So he sees this risk to reward and says, okay, interest rates are clear, risk to reward. So we will invest in interest rates. We're basically putting our money in the bank. So he puts his 100 USDs in the bank, he gets per annum 2%, and he's happy. Now, however, the bank changes interest rates and puts them down to 1%. So now also this risk to reward changes. He's now got 1 to 1.67. So what does Mr. Tom do? He sees, okay, I'm rational. I want a higher risk to reward. So I will now invest in equities. So again, there's a higher demand for equities, which translates in a higher price for equities. And therefore, the share price, the stock market will go up. So this is the first. So in general, we can say that if the interest rate goes up, that translates in a decrease of equities. And the first one is with a substitute. So basically, we have two available investment options, and we will take the nicer one. The second one is the more macro view. Nicer one, of course, I mean more attractive in the sense of returns. The second one is the macro view, which basically is about, we have Mr. Tom again, we have again 100 USDs, and we don't have 100 US dollars, but we have an interest rate of 5%. So Mr. Tom, he wants money. He wants to spend money as much as possible. But 5% is a high rate. So it means if he borrows money, if he borrows 100 US dollars, he will have to pay 5 US dollars back in interest rate compensation, basically, right? If you take out the mortgage or borrow money, you have to pay back. And 5% is quite a lot for this guy. So he says, no, I'm not going to borrow money. And as he doesn't borrow money, he's not going to spend money. He's not going to spend money on Apple. He's not going to be spending money on meals, on Coca-Cola, whatever. So as he's spending less money on goods, so less spending, as he hasn't borrowed the money. As he hasn't borrowed the money, there's going to be less. So let's say no borrowing. This means less spending, which translates in lower corporate earnings, which leads to a decrease in equities or stock. So again, Mr. Tom is a lot of Mr. Toms actually. And if they are all not borrowing money, they're all not spending, and they have a big impact on the corporate earnings. Let's imagine now rates drop. They drop 2-3%. So now Mr. Tom and some other guys, they say, oh, I will borrow money at that rate. I think it's fair. So they take out money, they've borrowed, they have a lot of cash, so they've borrowed money. They're spending nice on AirPods, on drinks, whatever. So they're spending. This means corporate earnings go up as they have the cash, right? People are spending for their products. Their profits go up, their earnings go up. And this means the stock price goes up. So equities go up as well. And that's exactly what happens. Again, it's very oversimplified, but I think it gives a nice overview.